Welcome to AM Best Audio.
U.S. auto insurance shopping activity shifted from hot to warm as both policy shopping and new business growth moderated, according to LexisNexis Risk Solutions' latest U.S. insurance demand meter. Yet, despite the slowdown, consumer activity remains well above historic norms, signaling a market still adjusting to evolving pricing, channel dynamics, and shifting retention patterns. As insurers balance rate movements with competitive pressure, what does it mean for loyalty and growth strategies ahead? I'm Lori Chortis for AM Best Audio, and joining us now to discuss that and other key findings from the U.S. Insurance Demand Meter is Greg Donaldson, Senior Vertical Market Manager of Market Intelligence at LexisNexis Risk Solutions. Greg, welcome. So great to speak with you. Thank you so much for joining us today.
Thank you very much for having me. It is a pleasure to be on.
Greg, how would you characterize the shift in shopping and new business growth? Are we seeing true stabilization or just a pause after elevated activity levels?
Well, one of the things that it's kind of important to talk about first is when we are talking about moving from, say, hot to warm, we're speaking about growth year over year. And the reason that's important to keep in mind is that we're still seeing positive growth. So 2024 was a record year. 2025 beat that record and was another record year. And 2026 is still beating 2025. So while the pace of growth may be slowing, we're still seeing increased activity. And that is truly remarkable. What the data tells us is that consumers are entering the market and they're really staying there. As of the last update, 47.3% of all of the policies in the market have shopped at least once in the last 12 months. That's almost half the market is out there looking. They may not all be switching, but the activity is staying high. And that's really what's interesting because it's not something that we've seen on a regular basis before.
Greg, what role are recent rate revisions and affordability pressures playing in shaping consumer shopping behavior today?
Well, that is a good question, especially leading into the type of market activity that we're seeing. We're shifting as an industry away from a hard market, and we're starting to open up a little bit. Carriers are starting to look for new customers. But from a consumer standpoint, even though rates are starting to stabilize, they're stabilizing at a very high level, much higher than it was just a few years ago. And consumers are thinking about it from the standpoint of a total cost of ownership. So when you think about buying a car, in the past, it was, oh, how much does the car cost? Now, consumers have told us that it's not just the cost of the car. The second most important factor that they consider is how much insurance is going to cost. And as the insurance rates go up, that becomes even more and more important. So if you're thinking about making a major change or a purchase, or even just thinking about what is the total cost of this vehicle to me, insurance is now a key part of that. And I think that the rate revisions that we're seeing are going to help a little bit, but because the rates rose so fast, you're still going to have isolated spots where consumers are just overwhelmed still. And a lot of that is driven by geographic differences. States are regulated, and they're regulated in different ways with, different setups. So carriers may be able to get rates instituted somewhere fast and somewhere else much slower. And what that causes is it causes a difference in the way that consumers are seeing those prices in their insurance bills. So while we look at a national level when we're looking at shopping and switching, you do see a lot of geographic differences. And when you take into account how expensive insurance has become as part of that total cost of ownership, it's almost like a wave. You'll see it kind of spread out across the country based upon what's going on. And then ultimately it'll settle. But I think what you're going to see is the rate revisions and the stabilization. I don't know that it's going to keep people out of the market. I think it's going to keep people interested enough to continue the activity that we've seen up to date.
Customize your data experience.
BestLink now offers an interactive company dashboard that provides company-level intelligence in a fast, user-friendly interface featuring interactive tables, charts, and Sparkline performance histories. Customize the dashboard tiles to prioritize the insurer ratings, data, and analytics that best support your workflow. AM Best. Our insight, your advantage.
Greg, older policyholders, particularly those 66 and up, continue to lead shopping activity. What does this shift mean for insurers' retention and acquisition strategies?
Lori, this is probably one of the most interesting things to me. I have over 30 years of experience in the industry, and one of the things that's always been like present, this has been just something that is a foundation of insurance carrier financials, is our long-term customers and making sure that they're happy, they're profitable, and that we can keep them on the books, because it's less expensive for a carrier to keep a customer than to go find a new one. So that's an important part of how they determine strategy. What we've seen is that the rate increases over the last few years got a lot of people off the couch that hadn't been off the couch in a long time. In particular, this 66 and older cohort. It doesn't take as much of a rate change to get them moving as it does some of the other groups. And once they enter the market, the most fascinating piece for me has been many of them are staying there. So if you're someone who's had a policy with a carrier for a long time, and all of a sudden your rates go up for no reason that you can discern, and you decide to go shop, you haven't shopped in a long time. So you're gathering your paperwork, expecting to go down to your agent's office, and somebody says, well, no, just go online and do a search. All of a sudden now you can get a quote very quickly with a lot less effort than you could in the past. Now it's not such a chore. I can order groceries online. I can go to Amazon and browse the mall online. And now I can go online and just shop for insurance. It makes it that much more accessible. And that cohort has really started to embrace that. And because they were such a key part of insurers' retention strategy and long-term financial strategy, it is starting to impact carriers. Those customers are shopping. And here's the most interesting part. If you take those customers and you think about whether they are, what their rate should be, how risky are they? If a carrier hasn't been paying attention and doesn't know that, then here's what happens. The best ones that a carrier doesn't know are the best ones, so they're not giving them the best rate. When they shop, they're going to find a better rate and leave. But the ones that maybe aren't as good as they were the day the carrier wrote them, they're going to go shop and get a worse rate, because the carrier that they're shopping with, all of a sudden they can see all of this activity that their current carrier doesn't see. So it's almost a catch-22. If you're not paying attention to your current book, it's going to affect your retention, of course, because those people are out shopping, but it's going to affect it by a greater magnitude, because some of those customers are really good and they will leave to find a better rate. And some of them are not as good and they will stay because you don't know that they're not as good.
The direct and exclusive channels continue to show growth while independent agents decline. Greg, what's driving that divergence?
One of the things, and I just mentioned it a minute ago, about the ease of shopping. So the direct channel is a lot easier and accessible for people on a day-to-day basis. You don't really have to go anywhere. It doesn't require a phone call all the time. So it's a little more accessible. That is part of the story. And when you combine that with the fact that a lot of carriers are starting to expand or develop their direct channels even more than they have in the past, you're getting more choice there as well. So as that continues, the data is telling us that we could see a continuous growth on the direct side. As far as the independent agent channel, part of that decline is driven by a subsegment of the overall market. You have a group of non-standard consumers who typically shop with independent insurance agencies, which are generally the preferred channel for non-standard carriers. They shop in waves. Last year, we saw a big increase in the number of non-standard consumers that were shopping, and those carriers were writing those people. This year, the carriers have tightened up a little bit, so those consumers are not shopping as much. That's part of that that decline, if you will, in the independent agent channel. And I would think, based upon past data, that you'll continue to see increases and decreases. I don't think the independent agencies are going away by any stretch. But I do think there's a little more variability there based upon other factors in the market. And that's driving some of what we've seen recently.
Greg, looking ahead, and do you expect the market to remain in this warm range, or could we see another shift back toward higher volatility in shopping behavior?
That is a great question. I wish that I could look ahead and tell you exactly what's going to happen, because it would open up opportunities for me personally that I would take advantage of. But all we can really do is look at what the data tells us. Based upon past insurance market swings, we can see what has happened in the past. While this one has been different, what we do think is, based upon that data, we think that the overall shopping and switching activity will level off for a bit. So if we're talking about warm in the sense of year over year growth, I would expect that to remain pretty consistent this year. You might even see a slight decline compared to last year, but pretty much in line. But what that means is that the activity in the market is still very elevated. And it is going to be incumbent upon carriers to think about, how do you want to present yourself in the market? Marketing will only go so far. It requires a very broad effort to be able to manage your business from the standpoint of, how do you attract the right customer, keep the customers you really want to keep, and balance all of that. And that is kind of the market that we think that we're moving into, based upon the data, based upon the activity. So ultimately, we think that you're going to see consumers still in the market. They're still going to be shopping. You may not see them switch as much, but as long as we see rate variability, you're going to see people in the market. And we think that that is going to continue. And then we'll kind of see what the next 6 to 9 months brings. But I think that you will see elevated levels that continue at least that long.
Greg, this has been fascinating, so insightful, and it's been such a pleasure speaking with you. Thank you so much for taking the time to speak with us today. Greatly appreciate it.
It was my pleasure. Thank you for having me.
That was Greg Donaldson, Senior Vertical Market Manager of Market Intelligence at LexisNexis Risk Solutions. For AM Best Audio, I'm Lori Chortis.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.